Hello, it's Paul Scott here on Wednesday the 15th of July. I'm recording this at about 20 to 8 in the evening. I've got a bit of a backlog of companies that I haven't managed to write up in the daily reports, so I thought I'd do a quick video to touch on 5 companies that I wanted to mention to you. First one, several people have asked me to review the accounts, the final results for Begbies Traynor, the only UK listed insolvency practitioners firm, long established. The results here are for the year ended 30th of April 2015. I used to hold this stock. I don't currently hold it. So the headline figures don't look great. Revenue up a tad, but that's, I think, driven by acquisitions. So organic revenue is probably down a bit. Now, the adjusted profit before tax has really dropped sharply from 5.4 million to 3.6 million, so that's obviously a concern. Now, they actually report an overall loss of 0.7 million. Now, if you dig into the numbers, that's mainly because of exceptionals, quite considerable exceptionals, also some discontinued operations, loss-making. I do have a bit of a concern that this company tends to report a lot of exceptionals quite often. And it's done a hell of a lot of restructuring over the last few years to basically downsize because the level of corporate insolvencies just keeps dropping. We really are in a completely bizarre period that's a total aberration. It's not following any historic norms because, of course, interest rates have been so low since the end of 2008. We're completely into uncharted territory here in the insolvency market, and they say here that there's been a further 14% reduction in corporate insolvencies to the end of March 2015. The commentary, I've had a quick read through, they're up against continued tough market conditions, and that's likely to remain so for the foreseeable future. I mean, even if interest rates do rise a bit, you know, if they go up to, say, I don't know what, 2.5%, it's really not going to make that much difference to the level of corporate insolvencies. So I think we just have to accept, or this company has to accept, which I think they have done by downsizing, that their market's going to remain tough for the foreseeable future. For that reason, the shares on the face of it don't really look terribly appealing. But there are a few things of interest here. I mean, the dividend has been maintained at 2.2 pence. Now, the shares, that's giving a yield of over 5%. So if we look at the Stockopedia page, you can see that the shares have actually come off in the last few days. They're down to 39.75p. So the dividend yield's very attractive at 5.4%. Looking at the divvies, it's been maintained for several years. So it was cut in 2010 from 3.1p down to 2.2p. Sorry, in 2011 it was reduced. But they've maintained that 2.2p ever since, which suggests to me that they're struggling to pay 2.2p. Normally when you see a fixed figure there over and over and over, that is saying the company's struggling to pay that, because really what you want to see is a sort of 5 or 10%, maybe more, increase in the annual dividend each year. The dividend cover, you can see, is low as well, which reinforces that point. But still, it's not bad. If you're a long-term investor, collecting in a 5.4% yield each year is pretty attractive. Going back to the figures then, other things I noticed, they did a placing to make a smallish acquisition of a property valuer called Edison's. So it's now organised into 2 divisions. You have the insolvency division and this property valuation division, but the insolvency division is by far the bigger of the 2. Now look, net debt's come down quite a bit, not just in the year from 14.5 to 12.8, but if you look at the Stocko page here on net debt, you can see there's a nice sort of downward trend now on debt, now that it's come down to 12.8 million in the current year. This is a very interesting balance sheet because it has huge WIP, basically, work in progress, stroke debtors. A bit like, very, very similar to a legal firm. I mean, insolvency practitioners are kind of hybrid law and accountancy firms, effectively. So just look at the working capital figure there in that row. So let's take a look at the balance sheet. So scrolling down here, bear with me. Right, it got there. So you've got net equity of £61 million here, net assets 61 million, but 57.8 million of that is intangibles, which I think is almost entirely goodwill from various acquisitions. So that leaves a very thin net tangible asset base of only about, what's that, only around sort of 4 million, less than 4 million, isn't it? Negligible, really. But you don't have much in the way of fixed assets. The only fixed assets for this type of business will be office fit-outs and some computers and probably some company cars, and that's about it. Now look at the working capital position here. The big number, you see, you get 44.1 million current assets, but look at the trade receivables, 34.8 million. That's huge, and that compares with turnover of 45 million. So now normally I would say, yeah, gigantic red flag, debtors sort of half to 3/4 or something of turnover, don't touch it with a barge pole. But I know this sector very well because I worked in it between 1990 and 1993. And insolvency practitioners effectively work for the banks, who are usually the secured creditor, and the banks extend them short-term financing for them to run administration jobs, or what used to be receivership jobs, and they run an enormous work in progress and debtor balance here, which is then paid in one big lump sum when the case is closed. Now that's fine as long as that debtor figure is managed properly and is correct. So there is a risk that it can accumulate a lot of junk in there. But I think Begbies has got a pretty good track record on this. They've been going a long time, they've been listed a long time, so it all boils down to trust. I think broadly, no, not broadly, I do trust this company. The 9.2 million cash there at the end, so 44.1 million current assets. Now look at the current liabilities, only 13 million. So you've got a current ratio there, which is very strong, of 3.4. That's exceptionally strong. Huge figure here in net current assets. However, before we get too excited, that's funded by a £22 million bank loan here. Now, interestingly enough, the bank debt at Begbies is unsecured, so it's not even secured on the debtor books. Now, that really tells you how comfortable the banks are with this company. Unsecured debt is very unusual. They've got a 30 million facility, so they're comfortably within that. Overall, I'm pretty comfortable about all of this. Another positive factor, so even though the balance sheet's very peculiar, it's fine as far as I'm concerned. Other points I want to mention, though, is that adjusted EPS was down from 4.7 to 2.9p. There were some new shares issued in the year, so but the outlook's quite good. If you look at the current year, what they're saying is they've shut down some loss-making discontinued operations, so that's going to help the new year figures. So if you're getting dizzy watching me scroll through here. And also, of course, the acquisition of the property firm is going to contribute a full year, whereas I think it only contributed about 4 months in this year under review. So yes, here you are, that's that paragraph there, full year contribution from the Edison's acquisition coming in. Reduced cost base, removal of losses from discontinued businesses, and so on. So they're reasonably well placed. So I think we can look at this year's 2.9p earnings per share, adjusted earnings per share, and say it's probably the low water mark. I don't see any current forecasts for Begbies, but I would imagine you're probably looking at something like, oh, hang on, beg your pardon, there is a forecast there, 4.1p forecast for the current year ending April 2016, puts it on a P of 10, which is not bad at all. I mean, I think this stock's starting to look interesting again, but because people probably won't see any improvement in the insolvency market for some time, I think the shares could well carry on drifting down. I don't know. Look, you know, the chart doesn't look great, does it? The sort of uptrend topped out and finished there, and ever since really it looks to be in a drifting down sort of trend. So I'm not particularly minded to catch the falling knife here, but it's certainly going back on my watch list. Okay, so that's Begbies. Next, let's look at Manx Telecom. Obviously a fairly recently floated telecoms company serving the Isle of Man. This trading update today looks fine. It's for the first half to 30th of June. They're saying trading during the first 6 months has been in line with management expectations. There's more detail here. All sounds reasonably positive. If you like bank facilities here, renegotiated on improved terms and extended to 2020. If you like the company already, then this update today is probably reassuring. The shares have done quite well. This is since it floated, which was in whenever that was, February 2014. It's been a good performer. It's gone up a little bit, a modest amount, gentle trend upwards, as people are obviously chasing this. Again, same as Begbies, a 5.4% dividend yield. My only concern on this is that there's the balance sheet's quite weak. Look at the price to tangible book, 62 times. So you've really got very little net tangible asset backing on this company. I did a write-up on it on my report here of 14th of April. So when the share price was, I think, about the same as it is now. And I flagged up here that the balance sheet's weak, quite a lot of debt, mature business, but they've got one section here, one division here, Global Solutions, that is growing quite nicely. It's not for me, this share generally, but it might be of interest if you like high yields and you're not bothered about weak balance sheets. Right, next let's have a look at Interior Services Group. Now this one was a complete car crash, I'm afraid, earlier this year. It's a very, very low margin business. Look at the turnover here, 1.6 billion forecast for the year just finished, only 5 million profit, and historically, negligible profits. It does interior fit outs for office blocks and so on, and really it's just a sort of job creation company. I think shareholders, the dividends have been paid out decently in the past, but then they had to do an emergency rights issue or placing or something earlier on this year. I've covered it in previous reports, so if you click on the Discuss tab, you can look back at my previous. Actually, let's do that now. You can look back at my previous commentary on that. Well, let's see when it dropped. When did it drop? That is February the 2nd, 2015. I remember covering that. Yeah, here we are. So I don't think we've really got time to go into that. You can read up on it there if you want to. Anyway, to cut a long story short, its shareholders backed it with emergency refinancing. However, although I wouldn't normally touch it with a barge pole, it's based out now. It looks as if it's over the worst on the chart. And certainly the trading update here is actually quite encouraging for the year ended 30th of June. They've said here performance in H2 has been excellent, trading ahead of management's expectations. Now, on a business that makes such a tiny gross profit, a net profit margin as this, very fine sensitivities is what I'm trying to say. Huge turnover, tiny profits. They're saying that the pipeline is good. I mean, this sector generally, commercial building, is pretty buoyant at the moment. You've got other companies like T. Clark, ticker CTO, which I hold, Waterman, WTM, which I also hold, which are reporting pretty buoyant, that it's a pretty buoyant space. And this company seems to have got over its problems earlier this year. So it's something that, is in my sort of, after reading this statement here for this week, it's a possible punt, I would say. There's a big net cash balance here at 50 million. There we are, 17 million of new equity raised in March. I think that's basically funded though by the customers' upfront payments and by stretching payments to subcontractors, which is very much how Renew Holdings and various other companies in this space operate, or in vaguely the same sort of sectors. I know Renew is mainly rail related contract work, and it's higher margin, so they're not directly comparable at all. This is interesting. In view of the improved second half operating performance, the group, the board expects to pay a final dividend of 5p. That's really encouraging for a group that's essentially been bailed out by its shareholders just a few months ago, to now be whacking through similar dividends to what it was paying before that crisis is very encouraging. The forecast dividend yield's 5.3% for next year. So it looks as if this company's on the mend. I might risk a small punt on this. I wouldn't put a lot of money in it because it's too high risk, but it looks interesting. I don't hold any at the moment. Quickly on a couple more. Next 15 Communications. I'd rather take my eye off the ball on this one. It's a stock I liked about a year ago, and I hadn't actually noticed that the shares have almost doubled in the last year. Forward P of 13, dividend yield of 2. This update on the 14th of July, a couple of days ago, no, yesterday, positive start, has extended into the first 5 months of the period. This all reads pretty encouragingly. Now this final paragraph mentions some notable additional business from Google, Unilever and Carnival Cruise Lines. Some nice big name clients there to name drop. And they're saying that puts the group in a strong position to deliver on the board's expectations for the current year, which I read as hinting that they might beat expectations, possibly. Maybe I'm being too bullish on that, I don't know. So, but it looks interesting, but I don't think I'd buy in now. I think that would have been a nice stock, obviously, if I'd held on to the ones I did hold a year ago. I'm not going to chase it higher, though. I think it looks probably priced about right. Marketing companies tend to be on PEs of sort of between 10 and about 13, which this one is. So I think that's fairly priced now. And finally, Net Dimensions. I don't really know much about this company, but there was a pretty positive sounding update yesterday. I think some friends of mine are in this one and seem to like it. Revenue for the period was up 16%. They're saying that it's going to be an H2 weighted year. This all reads pretty positively, but I noted from the stock report that I was down nearly 5% today. I don't know why that is. I noticed from the stock report that it's been loss-making historically and is only forecast to be, well, slightly loss-making this year and a tiny profit next year. So it doesn't immediately jump out at me as being particularly interesting. Also, the broker forecasts have been reduced several times in the last 12 months. The other thing I don't like is it's Hong Kong based. I mean, I'm not keen on overseas companies listed on AIM, as regulars know. But however, if you look at this long-term chart, since it listed, bombed out here at about 6p in 2008. Well, look, since it's performed very well. It's been a sort of 12 bagger since then, 13 bagger. So that one might be worth a deeper look, possibly. I don't know. I don't hold any. Right, sorry, I've overrun my time. I hope that was useful, and I've caught up now with the backlog of stocks that I wanted to cover. So I'll see you in the morning for the usual written report. Okay, thanks then. Bye.